All right, so you're here because gold has piqued your interest, right? You're thinking about adding it to your investment portfolio. Makes sense. Today, we're going to take a deep dive into a Bankrate article that lays out all the different ways you can actually invest in gold.
That's right. It's important to understand your options whether you view gold as a safeguard against economic uncertainty or just an interesting asset class. This article breaks it down into 5 main approaches. You can buy physical gold bullion, trade gold futures contracts, invest in ETFs that hold physical gold, buy stock in gold mining companies, or invest in ETFs that hold a basket of those mining stocks.
Our mission today is to break down each of these options for you. Not just what they are, but also the real-world pros and cons to consider. By the end of this, you'll be well on your way to feeling totally comfortable with the ins and outs of gold investing. And speaking of real-world considerations, just something to think about. While owning something like a gold bar might sound cool and give you peace of mind, there can be some downsides to that. Okay, let's start by breaking this down. We'll start with the most basic way to invest. Gold bullion. When we say bullion, what are we actually talking about?
Basically, gold bullion is just physical gold, like bars, ingots, or coins. I think the main attraction is the tangibility of it. You actually own something real. Especially in uncertain times, some people find real comfort in holding a physical asset compared to, just having some numbers on a brokerage statement. Historically, in times of crisis, physical gold has held its value pretty well when other assets have struggled.
Yeah, that makes sense. Having something tangible is appealing, but it's not as easy as just stuffing cash under your mattress, right?
No, not really. There's some real costs associated with owning physical gold. You'll need a safe place to store it, maybe a safety deposit box at your bank, or a heavy-duty safe at home. And of course, you're going to want to insure it against theft or damage. Those costs can add up and eat into your returns over time.
Okay, so with bullion, you're making money if the price of gold goes up. It seems pretty straightforward.
Yeah, it is. Bullion profits depend entirely on the price of gold increasing. Unlike, say, a gold mining company that can grow its operations, discover new deposits, and even pay dividends, gold bullion is just sitting there. Its value goes up and down only with the price of gold itself.
Makes sense. So let's say you decide to go the bullion route. Where do you even start buying it?
Well, the article mentions a few places you could look. There are online dealers like APMX and JM Bullion. They specialize in precious metals. You can also find local coin shops or precious metal dealers. And sometimes even pawn shops might have gold you can buy. Just got to shop around and do your homework.
Good advice. And the article emphasizes the importance of checking the market price, right?
Yeah, the spot price of gold. That's what you want to look at because it reflects the current market value. You want to check it as close as possible to when you're buying so you know you're getting a fair price. The article also recommends buying bars instead of coins. With coins, you often pay extra for their collectible value, but with bars, you're just paying for the actual gold content.
Smart. If you're serious about investing, skip the collectible stuff. So we've talked about storage and insurance. What are some of the other downsides of owning physical gold?
Well, the big ones are theft and difficulty selling. Having a lot of gold makes you a target for thieves, so security is a real concern. And then when you go to sell, it can be hard to get the full market price, especially if you need to sell quickly. Local buyers might lowball you. You might do better on a bigger market, but that takes time and effort.
Okay, physical gold. You can hold it, but it comes with its own set of challenges and responsibilities. Let's move on to something a little more complicated. Gold futures. What exactly are we talking about here?
So gold futures are basically contracts. You're agreeing to buy or sell a certain amount of gold at a set price on a future date. Now, while it's possible to take delivery of the gold at the end of the contract, most people use futures to speculate on price movements. They're betting on whether the price of gold will go up or down.
So it's more about trying to predict the market than actually wanting the gold itself.
Exactly. And the big draw with futures is leverage. You can control a large amount of gold with a relatively small initial investment. That's what leverage means. So if your price prediction's right, you can make a lot of money really fast.
Leverage sounds like a powerful tool, but I imagine it can be risky too, right?
Definitely. Leverage can magnify your gains, but it can also magnify your losses just as quickly. If the price of gold moves against you, your broker might issue a margin call. That means they're requiring you to put up more money to cover potential losses. And if you can't meet that call, they can close your position and you'll lose big. Futures trading can be pretty volatile. You need to be able to stomach those swings and manage risk carefully. It's definitely not for the faint of heart.
It sounds pretty intense. So is futures trading something the average investor should consider?
Probably not. The article suggests that it's really more for sophisticated investors who really know what they're doing and understand the risks. And keep in mind, not all brokers even offer futures trading. You might need a specialized account.
Got it. High risk, high reward, and not for everyone. Okay, so let's shift gears to something that seems like a good middle ground between holding physical gold and messing with those futures contracts. ETFs that own gold. How do these work?
Well, gold ETFs are a more accessible way to get exposure to the price of gold. They're much easier than storing physical gold or dealing with futures contracts. Basically, an ETF is a fund that holds physical gold bullion. They sell shares of the ETF to investors, and the price of those shares tracks the price of gold, minus a small fee for managing the fund. That fee is called the expense ratio. It's usually expressed as a percentage. When people talk about diversification in investing, they usually mean spreading your money across different types of assets to lower your risk. But even though these ETFs only hold gold, they offer a different kind of diversification compared to holding physical gold directly, mainly because they're so much easier to buy and sell.
Right. The article talks about a few of the big gold ETFs. Could you remind us of those and what their expense ratios are?
Yeah, sure. So as of February 2025, there's the SPDR Gold Shares ETF. The ticker is GLD, and their expense ratio is 0.40%. Then you've got the iShares Gold Trust, ticker IEU. Their expense ratio is a bit lower at 0.25%. And the Air Brand Physical Gold Shares ETF, SGOL, has the lowest of the three at 0.17%.
So basically, you're paying a small yearly fee for the convenience of owning gold through an ETF. What are the big advantages compared to just buying gold bars or coins?
The biggest advantage is liquidity. It's so much easier to turn ETF shares into cash. You can buy and sell them on a stock exchange, just like any other stock. You get the market price, and it's really easy to do right from your brokerage account. You don't have to worry about finding a buyer for your physical gold or dealing with all the hassle of secure storage and insurance. ETFs make things so much simpler.
And what about the risks with gold ETFs? I know their value is tied to the price of gold, but are there any other risks to watch out for?
The main risk is definitely the price of gold going down. If that happens, the value of your ETF shares will drop too, minus that tiny expense ratio. But keep in mind that while gold can be volatile, the ETF structure itself helps protect you from the risks of owning physical gold, like losing it to theft or having to sell it at a discount because you're desperate for cash. ETFs generally trade at or close to the market price of gold, so you're not as likely to get a bad deal when you sell.
Makes sense. So gold ETFs. Easier to buy and sell, they track the price of gold, much less hassle than physical gold, but you're still exposed to the ups and downs of the gold market. Okay, let's move on to another way to potentially benefit from gold, investing in gold mining stocks. What do those look like for the average investor?
So with mining stocks, you're buying shares of companies that actually dig gold out of the ground. The interesting thing about mining stocks is that you have two ways to profit. If the price of gold goes up, miners usually make more money because their product is worth more. But also, well-managed mining companies can grow their business over time. They might increase production by finding new gold deposits or improving their mining techniques. That can lead to higher profits and potentially higher stock prices. You're not just betting on the price of gold, you're also investing in the company's ability to be successful.
So it's a little more complex than just earning the metal itself, right?
Yeah, exactly. There's more to research and understand, but that also means there's more potential upside. But of course, there's also more risk. The article stresses the importance of doing your research on individual mining companies. You need to understand their financials, their operations, the quality of their management team, and even the political risks of where they operate. Some mining companies are definitely riskier than others, especially the smaller ones, or companies that are still exploring for gold and haven't actually started producing it yet.
So you shouldn't just invest in any company that says gold in its name, right?
Right. Look for companies with a solid track record, companies that are already producing gold and making money. And like any individual stock, keep in mind that mining stocks can be volatile. Their prices can go up and down, and they're exposed to all sorts of risks that go beyond just the price of gold.
So mining stocks offer potentially higher growth because you're also betting on the company, but they come with the inherent risks of any individual stock. Now, what if you like the idea of investing in gold miners, but you don't have the time or expertise to analyze all those different companies?
That's where ETFs that own mining stocks come in. These ETFs are a basket of different gold mining company stocks. Instead of picking individual companies, you get exposure to the whole sector. And if one company in the ETF does poorly, it doesn't hurt your overall investment as much.
I see. The article listed a few examples of those
Yeah,
ETFs.
you've got the VanEck Gold Miners ETF. The
Okay.
ticker is GDX, and their expense ratio is 0.51%. Then there's the VanEck Junior Gold Miners ETF. That one's GDXJ. They focus on smaller, newer mining companies, so it tends to be a bit riskier. Their expense ratio is 0.52%. And lastly, there's the iShares MSCI Global Gold Miners ETF. The ticker's RAIN2, and they have an expense ratio of 0.39%.
Got it. So they're a little more expensive than the physical gold ETFs, but you're getting that diversification across the whole sector. What are the key benefits here?
Well, the main benefit is that you get the potential growth of owning mining stocks, but with less risk because you're diversified. You're not putting all your eggs in one basket. If one company has a bad year, it won't tank your entire investment.
And what about the risks?
Well, even though diversification helps protect you from individual company risk, these ETFs can't protect you from problems that affect the whole industry. Like if the price of gold stays low for a long time, it can hurt all the gold miners and the ETFs that hold them. And the article points out that you should think about your risk tolerance when you're choosing a gold miner ETF. Some funds are riskier than others. ETFs that focus on junior miners, for instance, those are going to be more volatile than ones that hold mostly large, established mining companies.
Great point. Choose the ETF that aligns with your personal risk tolerance. So we've covered the 5 main ways to invest in gold, according to the article. Let's take a step back for a second and think about the bigger picture. Why do people even invest in gold in the first place? What makes it so attractive?
That's a good question. The article quotes an expert from the World Gold Council, Juan Carlos Artigas. He points out that gold has a long history of providing returns. It's relatively liquid, and it doesn't move in the same direction as stocks and bonds. Those characteristics make gold a good tool for diversifying your portfolio.
Let's dive into this a little deeper. What about gold's track record for returns? Has it been a great investment historically?
It's been okay. The article acknowledges that while gold has outperformed stocks and bonds in certain periods, like during times of economic crisis, its overall long-term returns aren't as high. It's not going to make you rich overnight, but it has a history of holding its value, especially when other assets are struggling.
Okay. And what about liquidity? We talked about that with ETFs, but what about gold in general?
Liquidity just means how easy it is to turn your investment into cash. ETFs that hold gold or mining stocks are pretty liquid because they trade on exchanges. You can buy and sell them quickly and easily. Physical gold can be less liquid. Selling it quickly might mean accepting a lower price. It really depends on how much gold you have, where you're selling it, and what the demand's like at the time.
Got it. So ETFs tend to be more liquid than physical gold. And the last thing was low correlations. That's something you hear a lot about with gold. Why is it so important for investors?
Yeah, low correlation means that gold doesn't always move in the same direction as other assets like stocks and bonds. Sometimes it moves in the opposite direction. And that's great for diversification. If your stock portfolio is taking a hit, your gold holdings might be going up. That can help offset your losses and reduce the overall volatility of your portfolio. It's like an insurance policy against market downturns.
I like that. An insurance policy. So it's a diversifier and a hedge against uncertainty. But the article also talks about some of the drawbacks of investing in gold.
Yeah, it's important to see both sides. One problem with gold is that it's hard to know what it's really worth. You can't analyze a gold bar like you can analyze a company's financial statements. The price of gold is mostly driven by supply and demand and by how investors are feeling about the economy. It's tough to say whether gold's cheap or expensive at any given time.
So basically, to make money on gold, you have to find someone willing to pay more for it than you did.
Yeah, that's the gist of it. It's different from investing in companies, which can generate profits through their operations. Gold doesn't do that. And that's a big reason why investors like Warren Buffett aren't crazy about gold. They prefer to invest in businesses that make money. And they like the simplicity and liquidity of the stock market.
Okay, that makes sense. So to sum up, what's a big takeaway for our listeners who are thinking about investing in gold?
The article concludes that there's no right or wrong answer when it comes to gold. It depends on your personal financial situation, your goals, your risk tolerance, and your overall investment strategy.
So as you've heard us talk about these 5 different ways to invest in gold, think about which approach best fits your needs and comfort level. Consider the pros and cons, and always keep your personal financial goals in mind.
And one final thought to leave you with. Gold has always been seen as a safe haven, right? Well, how do you think all the crazy stuff going on in the world, all the economic and geopolitical uncertainty will affect gold going forward? Will it still be a safe haven? How will it fit into a modern, diversified portfolio? Lots to think about.